The Philippines' substantial foreign reserves are one of the most important economic engines in the country. According to the most recent World Bank data for 2021, the Philippines has around $108 billion in total reserves of this size. It makes the Philippines one of the most populous countries on the Asian continent. At the same time, this figure is frequently at the center of various controversies. On the one hand, they believe that it is extremely low, comparing it to countries such as Japan or China. However, if we look deeper at its neighboring bloc known as Southeast Asia, Malaysia, Thailand, and Indonesia have larger reserves than the Philippines. Thailand, for example, has more than $246 billion in foreign reserves, which is more than double the Philippines. However, despite being a laggard, as some have claimed, there are still arguments to be made that the Philippines possesses adequate foreign reserves that are severely underappreciated. And this is why the foundation for how we should form this argument should not be limited to the amount of foreign reserves a country has. While having a high amount of foreign reserves is crucial, it does not cover adequacy in the face of external shocks. One of the most important criteria in determining the size of a country's foreign reserves, one that is frequently misinterpreted and overlooked when citizens discuss it. This is also a major reason why the Philippines is not at risk of losing territories due to foreign debt. People claim that the country owes excessive amounts of money to foreign lenders such as China and, at times, Japan. They overlook, however, that the government has a large quantity of foreign reserves that are adequate in comparison to its foreign loans. However, to properly comprehend the significance of the Philippines' foreign reserves, the first key data point from the World Bank's 2021 data, which shows total reserves in months of imports, or how much reserves a country has relative to its imports, shows that the Philippines has the highest in all of Southeast Asia's largest economies. According to data from 2021, the Philippines has approximately 10 months of total reserves and months of imports. Thailand, for example, has only roughly 9 months of total reserves and imports, while Vietnam only has 4 months. This is also an important data point since it shows how much the Philippines can absorb in the event of a recession. For example, in recent months, we've seen many commodity shocks, with oil and petrol prices skyrocketing. This put a pressure on Philippine imports, but it was fulfilled adequately because to substantial foreign reserves. In addition, imports. Aside from that, external debt is a vital indicator of how strong the country's foreign reserves are. The World Bank data set, which estimates total reserves as a proportion of external debt, is the second component here because foreign reserves are also used to settle external debt. You borrow in US dollars and pay in US dollars. The dangers are likely to be devastating. Several economies around the world have collapsed due to foreign debt. The Philippines crisis in the early 1980s was even a historical event involving foreign debt. As a result, greater foreign reserves are required to cover its external debt. As of 2021, the Philippines has approximately 102.2% of total reserves as a percentage of external debt, which is more than both Vietnam and Indonesia, and only slightly lower than Thailand. This is a crucial component in understanding why the Philippines is in a better position in terms of foreign reserve sufficiency. It is also worth noting that a country's foreign reserves are quite important. The greater it is, especially in comparison to its foreign debts and imports, the more stable the country may be. Other than the Philippines crisis in the 1980s, there have been numerous incidents in history that produced a fall in events when it comes to foreign reserves. One such example is the 1997 Asian financial crisis, which witnessed massive capital outflows from both Southeast and East Asian economies. This wreaked havoc on governments, private firms declaring bankruptcy, and financial institutions as their foreign reserves ran dry. As a result, the International Monetary Fund and the World Bank issued tens of billions of dollars in emergency loans to ensure their survival. Furthermore, having such large foreign reserves is vital for both investor confidence and creditworthiness. According to the most recent S&P credit rating, the Philippines has a BBB+ rating, which puts it higher than Indonesia and Vietnam. And, like Thailand, it is greater than other recently industrialized countries like Mexico, South Africa, and Brazil. Despite this, it is unfortunate that Filipinos have misconstrued. How big are the Philippines' foreign reserves? A common misperception regarding the country's foreign reserves concerns the Philippine trading industry. Many people are aware of the disaster. For context, the Philippines buys more than it exports. The Philippines had a trade deficit of more than $50 billion in 2022. This indicates that the Philippines imported more items than it exported, which is not a healthy indicator. However, despite the country's poor trade deficit, which is not confined to 2022 alone, but has occurred multiple times in the last decades. The total balance of payment, which is a notion that calculates the inflow and outflow of money, is positive. That is why, despite a trade imbalance in the billions of millions, the Philippines' foreign reserves have continued to rise. There are major players in the Philippines' complete balance of payment industry that have contributed to the country's overall foreign reserve. Accumulation considerations are frequently overlooked since most individuals are preoccupied with merchandise exchange. For example, the Philippines is a major actor in the entire business process. As an outsourcing powerhouse, the Philippines actually exports more services than it imports. Indeed, a large portion of this is due to the call center industry, which receives billions of dollars in foreign inflows every year. According to the most recent data from the Philippine Central Bank, the service surplus was around $10 billion in the first 9 months of 2022, not enough to cover the large merchandise trade deficit, but it is a huge element on top of another big factor. Another component contributing to the balance of payments is the beneficiaries of abroad Filipino remittances, which are expected to total $36.1 billion by 2021. Other elements beyond OFW and BPS are at work in the sector. We can also acknowledge and be pleased that the Central Bank of the Philippines' careful monetary policy has helped regulate capital flows and, eventually, the accumulation of foreign reserves. This is also an important factor. When it comes to the Philippines' overall foreign reserves, these factors ranging from service exports to remittances from overseas Filipino workers have not only helped alleviate the burden of a large merchandise trade deficit, but have also helped increase the Philippines' overall foreign reserves to a level that has made the country's overall economic positioning to external shocks safer. But this is not to say that the Philippines should concentrate on where it is now. Certainly, the Philippines must address its trade deficit. It cannot rely only on services and remittances indefinitely. However, most people's claims that the Philippines is in a bad situation because of a lack of exports are wholly one-sided and must take into account the reality that there are other variables at work in the Philippine economic landscape. Finally, while these World Bank data points reveal that the Philippines is really ahead of most of its Southeast Asian rivals in terms of exogenous shocks, it is also not limited to its immediate neighboring bloc. Comparatively, the Philippines has a greater level than other newly industrialized countries like Mexico, Turkey, South Africa, and even a developed country like South Korea. That the Philippines has a larger foreign reserve, but to emphasize the significance of being protected against external shocks. But, in any case, let us know what you think, why you believe the Philippines has a bigger foreign reserve, or why you believe we are wrong and the Philippines is truly in a poor position. Thank you for taking the time to watch.